Hi, everyone. Welcome to episode 28 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by the actual star of the show here, Jordan Brooks, Senior Market Analyst. Jordan, how are you?
I'm great, Patrick. I can't believe we're on number 28 already.
Every time we do this, I can't believe that, that number, episode 28. So 28 months worth of this stuff. That's great. Well, we're talking this month about the November newsletter article. It's called Digging into Recent Rent Changes. Well, in the article, you talked a little bit about the seasonal component of decelerating rent growth. Can you talk a little bit about parsing the seasonal effect from the underlying trend?
Well, we have to keep in mind when we're talking about, the rent growth that has slowed down over the past few months, that multifamily is a highly seasonal industry. And generally, the fourth quarter and the first quarter are going to be the softest, both for apartment demand and for rent growth. So, that has to be taken into account when we're talking about, September, October rent growth slowing. Absolutely. But once you statistically remove the seasonal effects and the random effects from the data, what you actually see is that average effective rent growth, at least for new leases, peaked in the back half of 2021. And ever since that peak, there's been a steady downward trend. And so what that also tells us is that the small bounce in rent growth that we saw during the summer really can be attributed to seasonal and random effects rather than a change in the underlying rent trend or market conditions more broadly.
A common response to the question of price pressure has been the lack of a quote unquote flight to affordability in the price class data. Is there maybe another way of looking at that dynamic?
I think so. I mean, in my view, I would say yes. I mean, when we talk about the flight to affordability, we're really talking about a dynamic where we're seeing residents pursue more affordable options many times down the price class ladder due to price pressure coming from rents. And so that would normally materialize as, especially low demand at the top of the market and relatively more robust demand in the bottom tiers. That isn't what we've seen in the data, and in fact we've seen the opposite, where Class A has been relatively robust, and again relatively is doing a lot of work there with what we've seen this year from a demand perspective. And it's been the Class C and the Class D space that we've seen really the most concentrated pain points from a demand perspective. So, but my read on that would be that, the average resident in a premium Class A property has been better suited to absorb the rent growth that we've seen over the last 18 or so months than a resident in a Class C property, for example. And then also Class A has the advantage of getting a little bit of a boost. It's hard to really identify what it might look like, but some level of boost from potential single family buyers that have been on the sidelines due to lack of supply, lack of affordability, rising mortgage rates, et cetera. And so that's keeping them in properties at a higher rate than we would expect, to lose Class C residents to home ownership. So really, when we're talking about what price pressure might look like in the Class C or the Class D space, it's not so much that you're going from a Class C property to a Class D necessarily, or a Class D to a slightly cheaper Class D or something. It's a lot of that is going to materialize as household consolidation. So people are either picking up roommates or moving back in with family, making other arrangements. And that's what we've seen. If you look at the net absorption numbers for Class C properties and for Class D properties nationwide, through October this year, they're both negative by more than 20,000 units, meaning that in those two price classes, we have roughly 50,000 less units leased at the end of October than were leased at the start of the year. And so, that's a little bit of a different take on kind of what we're seeing play out in the price class data, but I think that's an explanation that fits what we're seeing. And then also just, really from a common sense perspective, if we've seen, some markets, I'm out here in Tampa, approaching 40% rent growth since rents really started taking off in early 2021. Common sense would tell you that level of rent growth in so short a time is going to create price pressure.
Yeah, well, there does seem to be some regions of the country that kind of find themselves on either end of the rent growth scale in these last few months. Were there any particular markets or market types that stood out in the data one way or another?
Well, I think on the sort of the negative end of the scale, really the tip of the spear has been some of the high growth markets that have seen some of the highest rent growth numbers, in 2021 and into the early parts of 2022, that have kind of been the first to find themselves in negative territory now. So in that case, we're talking about areas like Boise, Phoenix, Las Vegas, Austin, again, sort of Sun Belt and Mountain West high growth markets over the last 3 to 5 years, I would say is sort of a general pattern that we've seen there. And we're not talking 5 or 10% rent declines. In the last 3 months, I would say the markets I just listed, we've seen between 3.5% and 1%, somewhere around there in terms of average effective rent declines. On the sort of the good side of the scale, I think a more general takeaway there has been that secondary markets seem to be holding up a little bit better in terms of rent growth momentum than primary markets. And then the tertiary markets, it's a little bit more of a mixed bag because those tend to go a little bit according to how their employment sectors are skewed one way or the other, right? But the secondary markets, if you just sort of parse the rent growth data according to primary, secondary, tertiary markets as groups, the secondary markets we still show at about 10% average effective rent growth through October this year, whereas the primaries closer to 8% and the tertiaries also closer to 8%. So that's kind of been the takeaway on the high end, and I would say that's held up in the last few months too, where we've seen the wind come out of the sails of rent growth in the last 3 months, but that's been less the case, again, broadly speaking, in the tertiary market, rather in the secondary markets as a group.
Right. Well, and I know that there's a lot of people out there hoping that wind does continue to die down in those sales. So, well, it is November as we're recording this. So you got a whole month of December ahead of you before we start the new year. What do you have coming up?
Well, I have no speaking events for the rest of the year. So,
wow. Okay.
Yes. So, attending some conferences still, but not speaking. So for viewers of this, I would just say, be on the lookout on our blog, alndata.com/blog. Things got a little bit hectic in the fall, and we weren't getting quite as much content up as normal. But here over the next month and a half, 2 months, you can expect some great content to go up.
Well, he's right. You can keep an eye out on our social media. You can follow us on Twitter at ALN APT Data. And you can also just search ALN Apartment Data on Facebook and on LinkedIn. Jordan, thank you so much for taking the time today to chat with me. I look forward to seeing you next month. I know that we will see each other next month. So that'll probably be, I think, the first time we see each other since pre-pandemic in person.
I think you're right.
Yeah. So I look forward to it. So Jordan, thanks so much. Safe travels, and we'll talk next month.
See you, Patrick.